So Sarah's asked our next question has come through the Facebook community, summarized as, what if I've invested for the required amount of time? Question mark. Maybe you can flesh this question out a bit, Kate.
Yeah, so we talk about investing for a longer period of time, 5 to 10 plus years. So what if, Sarah was just asking, well, what if you have invested already for that 5, 10 plus years time? You've invested for a long period of time and you're ready to do something with it. So you invested for a long-term goal, such as buying a property in 10 years or maybe even retiring. So how do you approach actually getting to the point where you are ready to use the money that you've been investing for such a long time for, especially if the market's a little bit volatile and you're a bit scared?
Yeah, so first things first, remember to keep an eye on when your goal is coming up or how far away your goal is. Like, goal tracking is not necessarily just about like, I'm going to get to $1 million and then everything will be fine. Like, when you approach $1 million, this is an example, you'll also have goals around that time. Or if you say, I'm going to get married and I want to in 7 years and I want to start investing now for that. Well, you don't get to, year 6.99 and then decide, okay, time to take all the money out. What you should be trying to do is effectively plan for the withdrawal as well. So just like you effectively plan to put money in, how do you take money out? And so as you get closer to your goal, you should be looking at thinking, okay, let's start to withdraw some money. What is the most effective thing for me, not just now, but in the long term? And so, for example, one of the things in the short term might be, well, maybe I should take some of my lesser performing positions because that will incur less tax for me. And then I won't have as big a tax bill when June 30 rolls around. Or maybe you think, I've held this investment for a long time, therefore I get the capital gains tax discount. Whereas this other investment that I have, I've only held it for 6 months or something like that. And the final piece of this is, we always talk about that money that's invested in the market probably shouldn't be in the market if it's needed in the next 3 years. So let's say, for example, you had a goal to save, $75,000 for your house deposit, and you knew that it was still 5 years away. Well, once you get to year 3, you might have $50,000 put aside. But then any extra money that you put into the market from that point on, you would have to question if you're going to need that sooner rather than later. So again, it's a bit of forethought here. You should be starting to put that money into cash rather than putting that money to work in the stock market. And it's because the goalposts do shift. They come towards you, they move away, depending on your goal.
Yeah. And I think we get into a lot of things. We get into investments, we get into jobs, we get into businesses, and we don't have any concept of what an exit plan looks like for us. And I mean, I haven't really done that before. I haven't, my goals are just pretty much right now financial goals and retirement financial goals. So I think that if I did have maybe a 10-year investing time horizon, if I had a specific goal for that, even when you're getting started or maybe halfway along the journey, starting to work out, well, what does my exit plan look like? When do I need this money? Am I going to slowly take the money out of the market over a 3-year period or something like that? Sort of like we talk about dollar cost averaging in, consider maybe dollar cost averaging out of the market. And I think it is a hard discussion. And I think you might have to sell something when you don't necessarily want to sell it, if that is really important that you buy the house this year. And I think it's, you have to weigh up those goals against each other. What's more important for you right now? And I think we should have more of a discussion about what is our investment exit plan. We talked about reasons why we might sell shares recently on the podcast, but when do you sort of exit your portfolio because you've hit the target you want?
Most people, you've talked about this before, at least we've talked about it, the two of us, is the psychology of FIRE investors is actually really interesting around this time, because for so long, FIRE investors, there's a question on that in just a minute. For so long, FIRE investors are like, I've got to save, I've got to invest, I've got to save, I've got to invest. And then they get to their goal and they're like, oh, actually I have to sell stuff? That doesn't feel right. That doesn't, like, I can actually spend money. Like it's all of a sudden, well, that's just a really poor generalization of FIRE movement, of course. But
but even like the self-managed super funds, like in Australia, there's a real mindset that you don't want to sell the capital, you just want to live off the dividends. Like selling capital is the worst thing you can do. But actually the superannuation system is designed that you sell a bit of the capital each year. And you don't just keep this huge amount of money forever. You're supposed to actually use it.
Yeah, that's it. And so, you talked about there, you should have your cash set aside. So that's the emergency cash. That shouldn't be used for like house deposits or that necessarily. And I'm sure we can say that and people still use it anyway. But the other thing is obviously to plan in advance. So you start building that cash position in advance, because it is true that when you sell anything, you may incur capital gains tax. Now, there are some exemptions, of course, like your primary residence. But if you're selling an investment in shares or ETFs, you're going to pay tax. So you want to avoid paying as much tax as you can. You want to keep that as low as you can. So starting to build that cash buffer before you hit your goal, like there's like a hard end on that. You can start, like you mentioned it, Kate, right now when markets are volatile, stock prices are falling, or at least volatile up and down. And so you might be a bit more conservative, and you might say, well, hey, my portfolio is out of balance anyway. I've got, I've only got 60% in shares and the other stuff's in bonds and, all that other stuff that we've talked about, defensive assets, gold, whatever. And you might say, okay, I need to get back in balance. Instead of rebalancing the portfolio, I might just sell some of my bond or my gold exposure and then take that off the table first. So that way it puts the portfolio back in balance while you're also withdrawing some money for your long-term goals. And then once the stock market comes back or starts to perform well again, then you can start to take some of that capital back off the table. It's a really kind of like gray area answer, because it depends how far your goal is away, what your saving potential is between now and then, and also your tax position. Remember that, the tax man comes no matter what you say. So just make sure that you can manage that.
Making sure you put money aside for any capital gains tax before you just jump into the next investment, I think is really important.